welcome out to your trading room as we prep for the week ahead, which will be April 29th through May 3rd. Let's get to it. So we're going to take a look at the news of the week, some broad market charts. There was an interesting fake reversal. We'll talk about sector rotations, and then we're always going to highlight our very best ideas, be that up, down, or sideways strategy.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the Apply button in the video description. Let's get ready for the week.
All right, so first, let's talk about last week and what transpired. We've rallied up now underneath a declining 20-period moving average. The 50-period is flat, but there was a fake pivot, and it was a significant one in my mind. We're going to look at that when we get to the charts, but essentially the market tried to set a lower swing high. It rolled over sharply intraday, even gapped down in the morning, but then recovered all of those losses. And those types of moves, you have to pay attention to them. They're significant. They're sort of little market tells. You know, if you were in a game of poker, and I'm not a gambler by any means, but poker players that are really good will look for signals. They'll look for market tells, right? What is this person doing? Well, maybe when he's strong, he does this. When he's weak, he does that. Well, the market is much the same way. We can see things that anyone that's brand new would certainly not spot and not put any significance behind, but we know a little bit better. So we'll look at those charts here in a moment. Commodities starting to lag a little bit. Gold, silver, oil, they're all at lower swing highs and have not gone back up to the prior highs like some of these other markets. Again, just the little pivots we're looking at here. And then the bond market continues to decline. The 10-year is all the way up to 4.62%. And why are rates rising again? Because the market has come to the realization that the Fed is not cutting rates at this coming meeting this week. And the markets came in just thinking that the Fed was going to cut rates dramatically. Goldman Sachs expected 6 rate cuts this year. It made no sense to me. It made no sense to us here at Maverick, and certainly is not happening. So the market's adjusting, and that's still playing out in the bond market. So let's look at this from the standpoint of what transpired last week. And usually the Bank of Japan meeting is just not that significant, but this past week it was significant because the Japanese yen just continues to collapse lower. It's at new multi-decade lows. There is discussion that the Bank of Japan is going to try to step in and basically try to curb that decline and try to do things in the markets to adjust policy and so on. And when central banks intervene in currency markets, it's long littered with just disastrous results, but they still try to do it, right? There's the old story of George Soros breaking the Bank of England. Well, the Bank of Japan, will they step in and try to intervene? Even if they do, in the short term, it'll move the currency. In the longer term, they'll lose that battle against markets. But it bears watching. Again, that Japanese yen just continues to collapse to the downside. Core PCE, which is a Fed measure of inflation, came in at 0.3% higher for the month. Obviously, that's a month-over-month number, but if you take 0.3 and you multiply that by 12 and you say, well, what if it kept doing that for 12 consecutive months? That's 3.6%. So, you know, on an annualized basis, if you're growing at 0.3% per month in inflation, you're at almost a 4% rate of inflation, which is much higher than the Fed's stated goals of 2%. So let's take a look at markets a little more clearly here. We'll jump into some charts, but it was a bounce back week given we've been in downtrends. Now, if you followed me in the market roundups, I typically do Mondays. I kind of talked about that. Look, if you think we're just going to collapse and not look back, I think that's the wrong outlook. Usually, if there's going to be a big cascading move that's just unrelenting and massive selling, that tends to happen when this downtrend is more long in the tooth, when people have been taking losses for an extended period of time, when margin calls and all these things are at a forefront, and people are just in panic mode and dumping their stocks. That's not going to happen when you're just a few percent, even 4 or 5% off of all-time highs. That's just not where this takes place. It takes place when you're down 15, 20%, So what I argued was, look, we're selling off, and of course, there's the old adage that you take the stairs up and the elevator down, which means, of course, you always go down in a little bit more violent way. You always go down in a little bit more rapid way, but it's just as expected. See how there's bounce backs, there's pivots, there's swing highs and there's swing lows. And that's kind of what we were trying to emphasize to our traders is, look, if you're expecting that it's just going to be violent and deteriorating and unrelenting, this just isn't the market. So it was perfect. You get a sharp sell-off. We should anticipate a bounce. We should expect that the bounce is pretty healthy. We should expect zigs and zags, right? That we're not in that environment where it just becomes day after day after day after day of heavy selling. We got a sell-off. We bounce back, and now where does that take us? Well, as we look at the performance, again, the things that lagged were oil and gold and commodities. That's not really bad for the markets. And what I found most intriguing about this rally was the day where it should have, would have, could have, right? There's a lot of, well, the market tried to set a lower pivot high, right? It had already made a lower low. It had bounced, a bear rally. It tried to roll over with a big gap down in the morning and even sold off early in the day. But that candle turned all the way back up. It didn't recover all of the losses on Thursday, but it recovered a good majority of them. And then, of course, on Friday, you went right back above that pivot high. This is what we would call in the markets a false move. It was a false reversal. It was a false bearish move. I touched on this in the market roundups as well. If you look at a chart of the VIX, when the VIX starts to have big red ugly candles at its top, usually you've set a short-term low in the markets, and that's exactly what transpired. We set our low, and now we're in the process of a real consolidation slash correction. Now, I'm not so sure it's going to new highs, but the idea that we can now be done with the downtrend is not out of the question, not at all. I mean, look, most sell-offs are in the magnitude of this 5%-ish range. They don't grow to 20 and 30% downward decline. So we'll see what transpires, but it certainly was a false move lower. And even though the charts have been rolling over and such, I think in the short term, we're going to continue to see a little bit more of this stabilization and a little bit more pressing to the upside. And then we'll see. But I would anticipate that the market's not done just yet in terms of its corrections and consolidations and so forth. So I don't think we're ready to just reverse hard and reverse lower immediately. I think there's going to be a little choppiness and a little more upside to deal with. You look at a chart of the QQQ, same thing. Big gap down, but then it recovered all of those and still growing back up. I suspect we're going to come up for a few more sessions, and then that's when it gets a little more dicey. That's where the rubber meets the road, and we've got to decide, okay, do we stay or do we go? And we'll be looking for, again, market tells, signals, something that suggests where we're going from there. Now, as we look at the markets, you got a lot of green over here in the semiconductor space, with the exception of Intel, which has been going to its own, demise. All of these other semiconductor charts have looked much better, obviously Nvidia especially, but Intel's about as bad as it gets in that sector. Meta, formerly known as Facebook, had a really rough week, but it's down 8 and Google's up 12. And Google's a little larger in market cap. Google initiated a dividend for the first time ever. Things that had been selling off violently like Tesla bounced back even more violently to the upside. And that's kind of how heavily shorted stocks work, right? You get bigger declines, more volatility, but you definitely get bigger rallies because all of that short covering is what can really fuel the upside. More green than red this week, certainly. As we looked at, markets were up about 2% across the board. So we have this bear rally short set up in the charts. The VIX signaled a bottom. We're still in that short-term bottoming out process. We think the bond market is key, and really you've got to stay below 4.8 or so percent in the 10-year. You start to get above 4.8%, and the likelihood that we're going to continue to decline in equities is higher. We've got more earnings coming out this week. Apple and Amazon, AMD, Berkshire Hathaway. I put in the B shares symbol here because you're probably not playing the A shares at $700,000 per share. You're trading B shares, right? ConocoPhillips, Coca-Cola, McDonald's, PayPal, Starbucks, and many more. Still right in the middle of earnings this week. Now, for this coming week, if we look at things that are most impactful, without question, we've got a Fed meeting. Now, there's not really any debate as to what they're going to do with rates at this meeting. They're going to keep them unchanged at 5.5%. No rate cut, no rate hike, etc. They're in a holding pattern. But the market, again, has been expecting a lot of rate cuts, and it has not happened yet. So we're still traveling down that road of the market questioning, when will the Fed finally cut? And at the press conference and the statement, they're going to be looking for any clues whether they're going to keep rates higher for longer or whether they're going to enter and start into that rate cutting cycle in the not too distant future. And then, as always, on the first Friday of the month, we get our payrolls number where we see how well the employment situation is doing here in the U.S. For the weekly outlook, as I said, initially I think there's a little bit more. I give this fake reversal. When it was happening on Thursday, I just thought, hey, this is significant. This is a rally that's going to have some legs. Should have, would have, could have sold off and deteriorated, and that's just not what happened. It gapped down and then it recovered all day long, and we've pushed above that pivot high again here on Friday. We're still in that upward phase of the correction. Now, I don't know that it's, again, I'm not so sure that we're going to new all-time highs or anything of that sort, but I do think there's a little bit more choppiness slash mild upside here in the near term. Now, as we break down sectors, there has been some movement within the sectors. We're going to look at each one of them. If we highlight strength and weakness for the past week, communications, consumer, and tech. These are all economically sensitive, what we would call cyclical. They move with the economic cycles. The more defensive areas that maybe don't move with the cycles as much, materials and energy, utilities, some of these other areas, defensive sectors like healthcare, those were the things left behind. And again, that's what the VIX suggested. The VIX, if you're looking at the volatility index, it says that the market lows are in. It said that about a week or so ago, and I highlighted that at the time of the market roundup. We at least established a short-term bottom, and just keep in mind, it is not out of the question that we have bottomed out entirely. So as we come in and look at a few of these charts, we'll start with utilities. Utilities still in an upward phase, right? We just made a new swing high. We are above the 20, above the 50. That's not the case in a lot of the broader markets and such. So utilities, clearly a stronger sector overall. Communication services, well, this was an interesting day. A huge gap down. We went from 81 or so, gapped all the way down here to 76, heavily influenced, of course, by Meta, again, formerly of Facebook. But then the recovery, bounce back, gap higher, recover most of those losses. And again, the downside in Meta was offset by the upside in Google and some of those names, and it just was kind of that false, plungy type of move. So I don't know that you rush in to buy, but if anything, it's probably They call this an island reversal, a bearish island reversal. And these bears, the people that got really bearish down here, they're trapped and they're in a world of hurt as you gap down to suck them in, and then you gapped away to trap them in a bad position. So still a little bit more bearish below those moving averages, but I worry about the communication services sector being able to sustain any sort of downward phase. Real estate still downward trending below the 20, below the 50. If you're looking for a better bearish area of the markets, real estate, this XLRE chart looks pretty solid from a bearish perspective. Healthcare also more bearish, down below a 20, down below the 50, still making lower swing highs, lower swing lows. Again, if you want areas of bearishness, I'd go for healthcare before I'd go for that communication services. I would go for some of these things that are a little bit more obviously in a downward trend. Industrials, a little more sideways to bearish. I'm going to give it a -1 in that we're still kind of figuring out where we want to go. We're below the 20, but just above the 50. We're chopping sideways. I mean, I kind of debated, is this a 0? Is this a -1? I went ahead and called it a -1, but I think it's in that 0-ish category. Here's XLF, same thing. You know, it's right around those moving averages. The moving averages are somewhat sloping sideways. It's essentially a 0 in the financial sector. Here's consumer discretionary. Now, some of these things bounce back, but that's because they were heavily sold off. Consumer stocks still below the 20, below the 50, downward sloping, still more bearish when compared to so many other things. So XLY, along with healthcare, along with some of those others, look more bearish. Tech still looks more bearish, below the 20, below the 50, downward sloping. Lower swing lows could make lower swing highs, etc. So while they were some of the biggest bounce backs, I think that's just when you push down really, really sharply that way, it kind of popped back up in violent fashion this week, but that's the way heavily shorted things tend to work. Materials, again, this is in that 0 to -1 type of category. I like it more as a neutral. I think there's things that are quite different within the material sector. You look within materials and you've got everything from gold and silver, which is more of a precious metal, but then over here you have other materials that are copper and steel, aluminum, and so on, that don't always move with the precious metals and such. So we went more 0 on that sector. And then energy, still above its 50, still some upward slope, so it's a little bit stronger clearly at a +1. If you're looking for things to buy, it's more in that utilities, energy space. That there's some upward trends in a couple of those areas. You've got more bearish charts, more bearish candidates from a sector perspective. Healthcare, still bearish. Real estate, consumer, technology, all potential bearish candidates. I would be, again, concerned about communication services. That was just a nasty reversal. Huge gap down, island reversal. So I'm not pressing anything in that sector in any way. So let's come in and look at some possible trade ideas here. I'm going to start with the healthcare sector, which was in our more bearish category. Here I've got Abbott Labs, and we've been in a little bit of a consolidating, kind of a low basing type of pattern down here after an extended run. Still good characteristics for bearish trading. You notice bigger volumes on the way down, lighter volumes during the consolidation. I think this sets up well as just a mild bearish move. I'm going to target a move below 105 and a finish below 105 by May 17th, which is the May monthly expiry. It's just a standard kind of 1-to-1 reward to risk ratio, pretty straightforward. If we're above 110, we lose. If we're below 110, we've got max profit at expiration. And again, it's just kind of in that 1-to-1 type of category. So low base pattern in Abbott Labs. If we look for something more in the sideways camp, this isn't necessarily it's upward trending, it's consolidating. It's certainly been going sideways now for a month, and I think it can stay there. I think this is a case where the sector itself is a little bit more choppy and sideways, and I anticipate this type of stock being a little more sideways. So when I put on a sideways trade, like I was looking at a butterfly, this is a good risk to reward because if I draw a risk graph on this butterfly, you got your profit over here, you've got your losses here. We can make up to $350. We can only lose, and I'll put it right here, 150. So we've got over 2 times the reward of risk. And you look at the risk graph, and there's a pretty big area that it can be in, right? If this is our break even on the risk graph, and we can only lose 150, well, we've got a range here. Our break even points on this type of trade become 46.50 per share to 53.50. And where did I come up with those numbers? Well, it's about $1.50 debit to trade this. And in a butterfly, you just take that debit price, add it to the lowest strike, subtract it from the highest strike, and that gives you your stock price break evens. So you notice here that we've got about a $7 window that we can be in between 46.50 and 53.50 at expiration to have some profit. Well, here's what I think of CCJ. It's going to move. It's obviously going to move. Nothing just perfectly flatlines, but as it moves, I think it comes back. As it moves, I think it comes back. And all you need is to waste a few weeks and then come back towards this $50 range, and you're already going to have a big profit. And I may not, always trade these to expiration. What you might do is go ahead and take profits on half of the trade. So say you trade 2 of these butterflies, hypothetically. You got $300 at risk because you paid $150 per. Well, if one of them goes and doubles in value, you could take profits on one of the 2 butterflies. Now you've got zero risk going forward. If the other one fails, you already cashed out for $300. You put $300 in to buy the 2. But if you cash out one for $300 and the other one grows to $400 of value, now you've got a home run type of scenario. So it's even possible where you can game plan to take profits on one of the 2 spreads, on half of your position size, that sort of idea, that sort of concept. So CCJ still looks like more of a sideways candidate. And then last but not least, the energy sector. Here you've got a bull pullback. This company does report earnings. I think it will trade above that 70 level, and it's one of those that just continues to trade to the upside and really has the support of Berkshire Hathaway and Warren Buffett. They continue to load up on shares. So I was looking at a May 67.50, 70 bull call spread. It's a good risk to reward where you can make twice what you're risking, that sort of idea. And all you need to do is finish above 70 for max profits. Again, it's not quite a 2-to-1, but it's in that category. So if we look at it, if you finish above 70 per share, you have max profit. If you finish below 67.50, which is current levels, you'd have your max loss, but your risk is lower than your max reward. So favorable for the standpoint of my outlook, my expectation, and the risk to reward. Now, markets had that fake out to the downside, and I think that signals again we just set a little short-term bottom. There were signs, there were signals, there was bearishness, there was just a lot of things that started to play out that the markets overdid it to the downside, and now we're getting a snap back to the upside. It probably has a little bit more to go, but pay attention to Wednesday. Fed meetings can always flip anything right on their head. I'm not anticipating any major surprises. I think the Fed's going to continue to be data dependent. I'm not anticipating them to change policy, but you never know for sure. I mean, there have been many examples. I remember when Bernanke and the Fed they had this target and they said, well, we're going to continue to do quantitative easing until the unemployment rate gets down to 4%, I think it was. And, that's our target. That's what it's tied to. And so they were printing money and pushing the economy forward. The unemployment rate was dropping. It went to 4%, which they had long said was their target. So the markets rightly thought, well, now the Fed will stop easing. They'll stop printing more money. They'll stop quantitative easing because we've hit the 4% unemployment rate. Economy is doing good. Wrong. The Fed made a surprise announcement and said, oh, that target is outdated. We're going to change it. We're going to keep printing more money. We're going to do more quantitative easing. That 4% was just a guideline. And of course, the markets just shot up. The futures went wild to the upside. Markets were closed, but we were up multiple percent because they just flipped a 180. They said, well, we're going to stop easing and stop this money printing when we hit here. And then they just flipped it and changed 180 from there, gave the markets no prior notice, etc. So you can never just sit back and be too confident, too comfortable about anything with the Fed. They leave open the possibility that they will change their mind at any point in time. Hope you enjoyed the trading room this weekend. Have a great week, everyone. We'll see you next time.